Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is special in that I am collaborating with Rob from Mindful Investor. So for more tips about Canadian dividend investing, please go to his channel, The Mindful Investor, also quoted in the comments. So let's look at some tips for investing for dividends in Canada. You want to look for eligible dividends to ensure low taxation. That is, Canadian companies on a Canadian stock exchange and headquartered in Canada. But check each company first to ensure that it pays eligible dividends. You can find this out on the corporation's website, in the corporate quarterly or annual reports, or in the shareholder publications. You may hold the company in a non-registered account if your TFSA limit is exhausted, since the taxation is so low on eligible dividends. If you have foreign dividend payers, then hold them in an RRSP because those dividends are taxed the same as an RRSP withdrawal and you don't pay the 15% tax withholding.
Thanks, Alesh, for having me on the channel. I'm Rob, the Mindful Investor. Alright, here's my tip. No need to stress over capital gains or losses. Having invested in the stock market for 15 plus years, sometimes I find myself checking the ticker symbols and getting emotionally invested in whether the stock was green or red that day. This only matters if we're making a speculative short-term play. As a true dividend investor, our main focus is on consistent dividend payouts. We should only be worried when the company starts to cut dividends or if the sector is in trouble. We have an example of Manulife here. Even when the stock tanked from a high of $27 to a low of $13 in 2020, their dividend payouts haven't missed a beat. The payout ratio is only 36%, so they have a lot of cash. This is critical to keep the investors happy as we move past this economic disaster.
The investing for income gives you extra cash flow and multiple sources of income to eventually live off of, but you can use it as an emergency source of income in the meantime. My dividends currently add up to about $45,000 annually. The dividends can be used to buy other stocks when you save the dividends to make up a lump sum purchase, or you can enable a DRIP, which is a dividend reinvestment plan, or you can live off the dividends. So let's look at some of my favorite dividend bearing Canadian equities. The first one is Enbridge. It's one of my favorites for dividends. I'm not saying that it's right for you, just that I own it. So Enbridge has an 8% yield and a cash flow that can cover that yield. The dividends have been increasing 16% per year for the last 5 years. It has relatively low debt for an infrastructure company, and it runs pipelines and charges for their use. So cash flow is independent of the price of the commodity, the so-called toll booth model. Additional pipelines are proving hard to build, so Enbridge's pipelines are more valuable. Also, 50% of Enbridge's business is in natural gas, which is much cleaner than oil if you are concerned about that. And it has started getting into renewable power generation segment as it pivots to renewables. This consists primarily of investments in wind and solar power generating assets, as well as geothermal, waste heat recovery, and transmission assets.
Here's one of my holdings, Bell Canada, BCE.TO. They have a 6% yield. The 5-year stock price hovered around $55. They've increased the dividend payouts for 6% yearly. Internet has become a staple in our lives. Some kids will even consider it more of a necessity than water. There are a couple of players in this space, but Bell leads the pack at 50 billion market cap. TELUS is 30 billion and Shaw is 12 billion. To be honest, I have all three holdings because the sector will get a huge boost from the illness.
And finally, we have Algonquin Power and Utilities Corp, AQ on the Toronto Stock Exchange, which is a diversified utility companies. It has a 4.5% yield and a payout ratio of 60%. The cash flow can easily cover the dividend. The dividend has been increasing 14% per year for the last 5 years. And the return on equity measure of management effectiveness is a respectable 15%. It has relatively low debt for an energy company. It operates a portfolio of electric, natural gas, water distribution, and wastewater collection utility systems and transmission operations. The renewable energy group segment owns and operates a diversified portfolio of renewable and thermal electric generation assets in North America and internationally. In summary, dividends are a great way to make money via your portfolio without using up your principal, but keep in mind that dividends aren't free as they decrease the stock price, even if it isn't visible due to the fluctuations in the stock price of that day. For the remaining Canadian tips, please visit Rob at The Mindful Investor. And if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.